Starbucks had a turbulent year. And while I admit the old CEO was not a good CEO, he didn't have the right vision for the company. I mean, he made Jim Cramer look like a financial expert in this interview, but I still think Starbucks is not a buy. I never thought it's a buy, and I will explain you why. First of all, I want to talk about the boycotts. They're like, oh, because of boycotts, we're losing. When we look at it, US, minus 2%. This is probably the only area where the boycotts could have happened. Very little people in Europe care about the boycotts. It's mostly just Americans. Sure, there's some Europeans, but it's not that much. And then when we look international, the people who care least about boycotts, at least when it comes about something because of Palestine, minus 14%. This decline is not just because of a temporary thing. This is just competition catching up with Starbucks and Starbucks' pricing power being deteriorated. But I don't know why the market was surprised by this. When it comes to the margins on the drinks, they have kind of flatlined since 2017. There is not much margin left, and they only pretty much had one big margin run. From 2012 to 2017, they were able to raise margins, but ever before, they have not been able to raise them. Well, now they have hit a new ceiling, and I don't see them breaking out of this ever. Sure, revenue keeps growing and growing and growing, but the times where Starbucks has grown at 20% is over. The high growing years are in the past. This is normal growth. 10% per year in revenue during the good times. That is what Starbucks is gonna maximum look like in the future. They're not gonna get more revenue growth. 10% is max. So everything else has to come from margins. And now we look at the competition. They're being crushed in China. Competition in Europe and the US is increasing. So I don't really see how this is gonna work out. How they're gonna be able to raise margins. They're probably gonna have to lower prices even, or not raise them for some time. But then you think, share buybacks. They do share buybacks. And I remember people saying after the stock crashed, good, they can do more share buybacks. Great for the company in the long term. Well, no, they can't. Free cash flow is roughly flat since 2016, so free cash flow margins have not done well. Gross margins, yes. Free cash flow, no. They had this one big spike in 2018 because they sold off a business there. Sure, maybe if we equal it out, maybe it's gonna grow a bit over time. Maybe it's gonna grow for 10% along it, some up years, some down years. But Starbucks free cash flow is highly volatile. And let's say it was 4 billion. Let's be generous. 4 billion free cash flow. Dividends, 2.5 billion. That's 1.5 billion left for share buybacks. That is barely 1%. Plus 310 million in stock-based comp, so this is around 1% in share buybacks that they can do from their organic free cash flow. The free cash flow yield on Starbucks is not high. It's trading at a 28 price to free cash flow. And even after the crash, they were trading at a 23 free cash flow multiple. That is not where I'm saying this company is gonna do lots and lots of share buybacks. And last time they had a massive share buyback program, they went heavily into debt. They currently have 21 billion in debt. Sure, they have enough free cash flow to cover that. 4 billion, 5 times free cash flow, easily doable. But you gotta remember, eventually you reach the limit of what you can leverage on. Plus, does Starbucks want to leverage on more debt right now? To buy back shares right now at elevated prices? When they know they have competition increasing, China minus 14% is disaster for them. This is their growth. This number doesn't include 2024 yet. Luckin Coffee has basically destroyed Starbucks in China. They're growing faster than Starbucks could ever. They're taking away market share from Starbucks. Their margin are still way below Starbucks, but this is where they can compete. 60% margin. They might only have a 9% lower margin than Starbucks, but that 9% means a lot to Starbucks. If you take 9% away from them, that is basically the entire free cash flow margin gone. Now, of course, Starbucks is not gonna have to lower the prices to Luckin Coffee, but there's the risk of a price war going on here. And a price war in the Chinese market. We know where that leads. Tesla entered a heavy price war in China and around the world. This is no comment on Tesla right now. This is not a video about Tesla, but just to show you what it leads to. The margin destruction from 15 to 5%. This happened with a lot of car companies. Not just Tesla, but Tesla started this price war. But the fact that this is the risk for Starbucks just shows you why I think a 25 multiple is just completely overpriced. I mean, even if I go past this 1% year-over-year revenue, let's say they grow back to 10%. Their margins stay flat, which I don't think will happen. They buy 1% of the shares back. For you to get a decent return on the stock, they would have to go back to 10% revenue growth, which they did some years ago when competition was not at all as strong as it's nowadays. They have to keep up their high margins, which is probably not gonna happen, and still be rated at a 25 multiple. So there are a lot of stuff that has to go very right for Starbucks. Now, of course, Starbucks still has growth opportunities international, but as you can see, they are being crushed internationally. Outside of the US, Starbucks is not as of an established brand as it's over here. For example, here in Germany, sure, people like Starbucks. Most people get their coffee here at the local bakery, or even at the supermarket. We have coffee machines in the supermarket. We don't have this kind of culture here where we need to go to Starbucks and spend $5-6 on a drink. We're not excited for the new fall pumpkin spice latte. And if there's a fancy experience, we're gonna go to one that's cheaper. And that's what's happening in China right now. They're going to Luckin Coffee. They're not going to the American brand. US, competition is increasing. Sure, maybe 2%, maybe because of a boycott, but well, there is no growth. Meanwhile, operating margins are going down. They're having problem with unionization in the US. So I don't really see anything that is gonna catapult the stock higher. Or even just grow it long term. Maybe the CEO can get it back to 10% growth, stabilize margins. He was very successful with Chipotle. But is he gonna manage to get that at Starbucks? Because Chipotle is a whole other business. They didn't have that much competition in their space. Starbucks, coffee, caffeinated beverages, very saturated. But overall, what generates shareholder value? Free cash flow. In the 5 years, you have returned 1% on Starbucks. And that's because free cash flow, since 2016, has basically stagnated. Meanwhile, in 2018, they had a huge share buyback program, which got them into heavy amounts of debt. Well, congratulations, that is now paid by $500 million per year in interest. Sure, that might come down when interest rates go lower, but it's not going to come down much. This is still a heavy amount of debt they took on. They're not going to buy back more shares, they're not going to take on more leverage. That is already a lot for them. Let's see what I would pay for Starbucks. They're currently making around $3.3 in free cash flow per share. Let's just ignore the stock-based compensation. That's another $300 million basically for free for them. What am I going to assume they're going to grow it? I don't think they're going to grow it 10% like they did before. Competition has heated up. Let's say 8% plus 1% in share buybacks. I don't think they're going to leverage up for the reasons I said. Slight slowdown after 5 years to 7% revenue growth and 1% share buybacks. Now, what are we going to trade at the end? Remember, in 10 years, the multiple should be lower, slower growth, and I don't think Starbucks warrants a 25 ratio right now. They're not a fast grower. They never were. They were growing at 10% for a very long time. Sure, they have a great brand, but the brand can only carry so much. Plus, it has been kind of deteriorated lately. So I think an 18 multiple, which is still fairly above the 15 average, is fair for Starbucks. It gives it a slight premium for the brand. 66% payout ratio with a little deduction due to taxes would give us a value of $66 per share if we want 10%. So in that case, not a buy. Now, what if everything goes very well with the new CEO? The CEO managed to turn the chip around. They go back to 12-13% revenue growth and buy back some shares. And get a 23 multiple because they're such a great company. Well, yes, then $116. Then you make money. But how likely is it that they're gonna achieve higher revenue growth than they did in the last 10 years? With how much more saturated the space now is. I don't think they're gonna hold this 23 multiple forever, especially not in 10 years on. This is not a cost go. Now, what if it goes worse? And with worse, I don't mean the company's gonna continue to grow at 1% like they did last quarter. Let's say they're gonna grow at 7%, or rather 6% revenue growth, 1% share buybacks, slight slowdown after that, and only a 15 multiple for a slow growing company that doesn't really have a big moat anymore. Well then, $50 a share, we wouldn't really make money with that. So I'm skipping Starbucks. I wouldn't have bought it after the crash. I don't think I'm ever gonna add it. It just usually trades too high for what the company intrinsically brings. At Costco, I could understand like a 30 multiple because it has such a huge moat, but Starbucks just doesn't have this moat, which has been shown in the last quarterly report. So what do you think? Write down below. Have a good day.